All right. Per usual, let me be a boomer and send this out the old fashioned way. Pretty, pretty epic AI bounce today. My friend Liam Dalton, we chat a lot on markets um, on YouTube. Uh, and I was like, "Do you think we rug here?" Just feeling it out, not necessarily thinking that we were going to in the morning, but just getting his view. And he was like, "There's so many guys that are caught off-footed by this that not now. If there's going to be a rug, it's not going to be now." That guy is super, super, super on it right now. He's been trading out of his mind. Sometimes you gotta take note of the hot hand. Okay, I'm going to get a shareable link. Send this to the Discord. Send this to everyone. Skip ahead a minute if you're watching this in hindsight. I'm too ADD. And then this is going to be the last live of the week. Because I'm going to San Francisco. In fact, I got to leave in like an hour. Get down there for dinner time. Alrighty. Yeah, so holy cow optics, holy cow memory. I trimmed some micron. Sold a call on coherent. I sold like a 350 weekly on coherent. If I go 260 to 350, like, you can take it. You can take it away. I just brought down micron. Um, I think I cut it in half in total. Maybe 30-40%. You just got to do something. Sometimes you just got to make a decision to cover all bases, and it's been a pretty epic bounce. So do that. Vicor. Eventually, I'm going to write up Vicor. I don't feel like I'm smart enough on it right now. The earnings sell off. It was halted, and I just bought. I bought at like 204, 206, and that bounce is looking good. I'm actually even on that. I doubled the position down there. Substack guys, no, it's not in the dashboard yet, and that's because if it's my PA, I can invest and then investigate. But because you guys tail me, you know, it becomes prohibitive. If I put something in there, it's going to stay in there. You know, if you're doing the Druckenmiller invest and then investigate, he'll buy something, he'll do work for 2 days, and he'll sell it because it wasn't the way that it seemed. I can't do that on the dashboard. Too much lead time and lag time on that. Bitcoin actually looks good. I mean, if you're looking at how cycles typically go, this thing's going to bottom again in September, October. But you got to have some exposure. You can't be too cute when it's at 60,000, now 65,000. Do I think it can go to 45, 40? Yes. Would I like it to go to 10,000 so Sailor gets completely liquidated and we can clear the decks? You betcha. But what you like and what you get are not always the same thing. I had an ex girlfriend that would tell me, you can't always get what you want, and I'm like, you could just give me what I want. Like, what do you mean? Like, this is your choice. You can't always, like, it's a law of the universe. Excuse me. It's in your hands. Speaking of in hands, Chamath, why'd you have to whack Groupon? Why'd you do that to me? I'm like, something's weird's happening. And the same thing happened when the IPO story came out, and I couldn't really figure it out for a second. The IPO story on the sum up stake, maybe Q1. It's just stupid. It's just stupid. I tweeted this out. I put it in the Substack first. I tweeted out, uh, I like these 35s. And the reason why I like these 30, and by the way, like there are hundreds of calls bought after I said that. Oops. The reason why I like these is because one, I think it's going to trade well up until the print. Estimates are too low. Um, you know, estimates are too low. If you know, you know. But also, it's going to maintain a lot of premium. Groupon moves like 20% per earnings. I think this earnings is not going to move 20% unless it's like a mega beat and then they could absolutely rip it off. But going into the print, if you're trying to trade this for like a week or, when it's like a week and a half until earnings, it's going to maintain a lot of that premium. Despite it being 116% IV, I think that remains attractive. Alternatively, you could get another month. You know, you could get another month so this thing could cook with numbers. Um, Management can do work, potentially have some positive releases. You could buy the 35s for about $2 in September. October's are probably too illiquid, although this has tightened up since I looked at it. You know what we need though? We need more strikes, more expiries. It jumps from October to January to December. How about a June? Can we get a June in there? That would be great. Although it would have been nice to have a June and May. I'll tell you that much. I like buying. Oh, I like the leverage when you have a high conviction. I'll buy shares and then I'll just try to get some convexity somewhere, depending on how the timing of it I feel. Um, but if it's a leap over a year, you get long term capital gains on that, which is pretty nice. And what's yeah, which is pretty nice. You just have to be careful that you don't exercise it and immediately sell it. Most of the time, then it becomes short term capital gains. Some of these tax rules are super dumb. All right, now looking at the chat, we're trying to. And like the substantially similar thing is kind of odd. You can move it like a month and $1 or a month and $2, and it's not substantially similar. So you can kind of wash trade that way. Um, Even if you just move it a month and keep the same strike, or a month and $1, I'm pretty sure you can say that's not substantially similar. Now, if it's up $1 on the same expiry, probably substantially similar. Just weird tax rules. Do not, no tax advice. That's like the least favorite thing for me to think about. I just plug my nose and say, Claude, how much money do I owe? Make it less, Claude. Make no mistakes, Claude. Yeah, I mean, listen, I like Amazon, I like Google all in. I don't know how Google's fucking up so badly on the model side, but the Tranium or Ironwood, I'm pretty sure it's Ironwood. The TPUs are actually pretty good. They are. We need a tremendous amount of compute. They're cheaper. In some cases, they're more power efficient. So I like that component. And the CapEx, it's funny. I just went on Jack Farley's podcast, and it's doing well, and people say they like it. So go over to Monetary Matters on Spotify or YouTube and watch that. But people are like pissed off at me that I'm like talking about something bearish, and I'm like, I think you can justify the AI spend in aggregate. And I clarified, I said in aggregate, and there will be massive losers, and still people got upset. Okay, I've done this, I've done this, I've done this. You know, it's almost like when I say something too much, I get bored, but it's still true, and I'll repeat myself. There are $22 trillion of services in the economy. AI does not just affect services, but let's focus on that. It does affect physical AI. You know, it does affect, even if you're, you know, a factory making goods, but you can do inventory better. You can model it out. You can do HR for that. Just because the $22 trillion, just because it's in the goods category, which is one third of our economy, about 30%, 25%. Doesn't mean that there's no AI, no benefit. It's just less. And it's, you know, easier to think about the services side. On the services side, you have restaurants, you have hotels, you have, you know, stuff that AI can help in the back office, stuff can help with the advertising of it. But generally speaking, we're talking about a 3 to 5% maybe benefit. Maybe improves margins a little bit. 3%, you know, margin improvement for a hotel or food is massive. So maybe, yeah, less. If you're talking about a grocer, they'd be lucky to get 50 basis points. But when it comes to the rest of the services economy, when you think about all the white collar jobs, you think about software. Software is like 400, $600 billion per year, maybe 800, depending on how you bucket it, whether it's just enterprise or it's also consumer software. You know, let's go in the high end of that. Let's include video games. Let's include all of it. Platforms, not just enterprise software. That's $1 trillion. Okay. Uh, the vast, just my view, I think 50% of that can be disrupted. And disruption doesn't mean 50% of the companies disappear, but it means that one company completely cannibalizes another company. You know, a lot of them do go bankrupt, honestly, or go away over time. And AI just kind of eats it. And they can eat it on the token side. You know, they can eat it by literally just taking out the use case. I'm talking to software guys, and they're like, shit, you know, we made 8x returns on LBOs and buyouts and software. On average, it's been amazing. Now our portcos are basically completely destroyed. It's real. Anyone that says it's not real, you know, the Zitrons of the world that want to be bearish everything, you know, say that there's no effect to software. No. The reason why it looks like software is still doing well and staying alive is because the contract lengths. If you were Workday, that's a 3-year contract. 3 years. Okay, so you sign up in 2024, that goes through 2027. So when you're not seeing the revenues go down, let's pay attention to the growth rates because that's going to be a leading indicator. When you think about $1 trillion of data center capex spend, average, my assumption is that it depreciates over 5 years. Maybe you say the chips depreciate in 3 years, the turbines depreciate in 10 years, the structure depreciates in 15 or 20 years. Average, let's just say it's, you know, networking depreciates in 7 years. Let's say average it's 5 years. Based on the cost of capital, that means you probably need to pull in over a 5-year average, about 250 billion per year. Shit. Both OpenAI and, you know, assuming we're on this, if we get into the whole Chinese model things, it kind of like makes the, you know, economics for the end user better. But let's just focus on OpenAI and Anthropic. Both of them next year are going to be, you know, covering that. So you can justify $1 trillion. Does that mean that I like neoclouds? Does that mean that I like every single spend in AI? No. But now we're thinking about it in a macro sense, top down. We have a $34 trillion economy. Can you justify $1 trillion of AI spend? Probably. Can you justify $2 trillion of AI spend? Potentially. And, when it comes to my insurance thesis, I when I'm in conversations, I make this point. I didn't on that podcast. I'm strong and I'm bullish AI. You may not be. You may be bearish AI and think software is oversold. Both of these things are on the insurance balance sheet. They just Texas hedged it. If one of them loses, their capital surplus is gone for the majority of these companies. It is, it's kind of like only one of those shots on goal needs to hit. There is a potential that software is uninvestable and the AI data center spend does not work because Chinese models come in and disrupt software just cheaper than can justify that AI spend, which would be absolutely hilarious. So that's that. Just a little bit of a ramble. The Jersey Mike's IPO, you guys realize that Blackstone is prettying that up for you and they're going to rug into your face. Okay. It's like you're buying a restaurant. Okay. Let's not get too bulled up on Jersey Mike's. Now, you could trade it. It could be memeable, but just understand 6 months in, all of a sudden the fundamentals are not going to be as good as the analyst said. And Blackstone is selling into your face. Yeah. So Matt, the open source models being used at scale is bearish AI and SaaS. The SaaS side, I didn't see anyone talking about it on Twitter, and of course, I'm shorting them. I wasn't really even talking about it. I'm like, listen, Figma went to 24, Workday's up at 140, and ServiceNow is up at 110. Like, guys, if it's even cheaper to make this shit completely irrelevant, that's definitely bearish software. Like, so at this point, so like the software bulls are just happy that OpenAI and Anthropic are hurting. Like their stocks are going down too, but they're like at least the hyper liquid valuations of OpenAI and Anthropic are going down. Okay, now AI infrastructure. Why is it bearish for AI infrastructure? Does China have chips? Are we going to put the data centers in China and undercut our data centers? Is the latency going to work from China? Is there underwater sea cables? Is there, quantum teleportation of compute? I don't think so. And so, yeah, I don't think so. Demand if on the model side it's cheaper, it doesn't change on the compute side, right? NVIDIA chips are still X, micro memory is still X, GV Vernova turbines is still X, and CMI reciprocating engines are still X, and Coherent and Lumentum networking are still X, right? So I don't really see how all of a sudden it's bearish for those economics. Who cares? If OpenAI gets cleared out, maybe it's bad for Oracle. But at the same time, if OpenAI's funding dries up because people are like, this is commoditized and uninvestable, it doesn't mean that people that are selling the, picks and shovels, the analogy itself is for a commodity. I don't see why it's bearish for the infrastructure. The commodity price is not going to go below the tightness of what it takes to have compute. Yeah, but it's very myopic to be like, well, this means that OpenAI is going to get less money and Anthropic is going to get less money. Why? Why? What's a simple supply and demand chart? Okay. If the price goes down, let's look at the demand curve. If the price goes down, this is price going down. This is price going down. What happens to demand? It goes up. It goes up. I just, it doesn't make any sense. I mean, we can call it Javon's paradox. We can call it what it is. If it's cheaper to get compute, there's going to be more demand for compute. If there's more demand for compute, there's more demand for computers. Just right. Now, what really the debate is, are AM, is it investable to train these models with 10, 20, 50, $30 billion if they can just be kind of distilled and one shotted? I don't know, but I'll tell you what, if we just stayed with Fable and Soul and the Chinese models and we just let those cook, the world would change. We don't need next gen models for the world to change or for there to be utility. They're good enough. I don't know why JFIN's selling off. Stanky. Stanky. Yeah, China's kind of gross right now. I traded Oracle. I bought a 124, sold at 130 or 129. I just it's overhated in my view. It turned out to be an okay trade, but if I just put that money towards fucking Micron, I did put money towards Micron, but if I put more money towards Micron, I'd be happier. Or AMD. Or Coherent. Yeah, I don't. Workday, ServiceNow, Adobe, Microsoft. Microsoft gets the added bonus of kind of like not doing the hyperscaler game well. Um, Figma, all of them. The obvious ones. That's it. They bounced. Okay. Software, everyone thinks it's over. Okay. People got squeezed out. Okay. Now we go lower. That's my view. I mean, listen, it would have been better to short it going into the year for sure, but I just think that there's way more juice left to squeeze. I think those things fundamentally deserve to be at a 5 to 8 times free cash flow. And that's because you're questioning the future. Now let's look at what where did CRM go? Okay, here. Okay. 2027 estimate, give me cash flows. Oh, it's right there. I did cover some today, by the way. It's fairly easy to trade around. Okay, so 15 billion. It's trading right now at 170 billion. So it's trading at 11 times free cash flow. I think that goes to 7 or 8. I do. What about ServiceNow? And I think a lot of people think 7 or 8 is super, super, super incredibly cheap. It's not that cheap. 7 or 8 years of free cash flow. How much is it growing? This is the analysts say I wouldn't be surprised if it misses that 15 billion number, but let's just do it based on estimates. Where did it go? Okay, ServiceNow. Yeah, so this is trading at 20 times next year's free cash flow. Can anyone tell me what the fuck ServiceNow does? Does anyone actually know? Because I'm pretty sure the majority of people just say buzzwords when they buy this stock and talk about the guy that wears glasses all the time. They do fucking tickets. It's like support tickets, enterprise tickets. And then they say they do AI on top of it. The fuck do you need that for? What's up, Slater? I think AMD's probably good, but AMD always hurts you around earnings. I think the whole semis earnings are going to be good. So yeah, I think ServiceNow goes to $50. Okay, what's next? Adobe. People think these stocks are so cheap. That's 20 times forward free cash flow. Can we chill out? It should have never been that high. Okay, let's do it. Let's see Adobe. Ooh, okay. I guess there's only one quarter left. Not really, dude. That's that the the growth on Adobe is falling off a cliff. 11 billion, 91 billion. Okay, that is, let's call it. It's about 9.5 times free cash flow, forward free cash flow. Maybe goes to 6. Last one. 6 times free cash flow is still, it needs to stay alive for 7 or 8 years and maintain that free cash flow. Like that's 6 years of free cash flow plus opportunity costs and, you know, um, opportunity cost of capital. I mean, do you really feel confident being in Adobe for 6 years to get your money back? Like, are you sure Adobe's going to be around in 6 years? What about Figma? 10 billion enterprise value. Like, what are we fucking doing here? 2027, 200 billion. Okay, who's paying for that? You think Figma is going to be around for 45 years? You think it's going to grow at 20% CAGR? Look, the growth rate to get there is 35, 23%. Free cash flow is going down. I don't know why. Maybe investments in AI. So they have to invest in AI just to, have slowing revenue growth for 50%, 41%, 35%, 23%. So this free cash flow is going down. Why is it going down? Partially CapEx, although $22 million of CapEx is nothing. Who's like legitimately, who is going to think that Figma is going to win spending $22 million? You go on OpenAI and use 5.6 Sol and you say, build me a website. It one shots a website that's better than the average engineer would do the old fashioned way, which is Figma. Okay. Bearish enough on software? Tenable. Holy cow, Tenable. Where's that report? Hold on. Some analyst came out with the dumbest report I've ever seen. And they whacked the stock. Now, is cyber technically software? Yes. Yes, it is. Was it Truist? Who did the Tenable downgrade? Was it Jeffries? 21? I think it was Truist. Wait, whoa. Did they bring it up from 27 to 40? I don't know. I think this was it. Okay. The report said they need more. They need more, certainty on whether or not the company's doing well. Your job as an analyst is to tell us, like, not that you're uncertain about things. What the shit is that? We need more. We need a couple more quarters just to make sure that the way it's looking is the way it's going to continue to look. Like, okay, like, why do we need you? I'm telling you, this vulnerability management is absolutely, like, it's way more threatened by China. Okay, I came out with this Substack. It was at 26 or 27, went up to 40. Now it's at 34. It's a buy. Okay, it's a buy. Lastly, let's go back to Groupon. I don't want to wait for my Groupon to get older. Okay. Into the next print. Let's look at the A&R. I want... Yellow, you're on live.
Yeah, I was wondering if you were live.
You are
What's
indeed.
going on?
I'm just closing it out. I'm going up to San
Yeah.
Francisco. How are you feeling? Tell the audience.
I'm feeling great. I'm abusing my Claude right now, trying to model the impending kind of lost barrels, potential oil spike ordeal.
Dude, it's going to 150. It's going to 150 and the Qs are going to 800 at the same time.
No. Dude, like the first one, actually, like, those things are both not possible. But basically, my thinking, very short thinking on it, is that I once again have Hormuz derangement syndrome. The last time I had this was obviously in March, April. I made the very stupid decision to actually try to express that view in financial markets. But it's such a novel, unprecedented, and severe risk to energy markets, which is literally the most opaque, most difficult to model markets in the entire world. That I got nuked in April, but this time it might actually happen because the MOU was the dumbest thing ever, because I thought the whole point of the MOU was that we were going to
Capitulate.
give them control of the Strait of Hormuz in exchange for taking apart their nuclear program. And instead, we decided to go back to contesting the Strait of Hormuz, which made them close the Strait of Hormuz again. And so, I think that at this point, it's why would Iran accept another MOU for us to, get more ships out of the Strait of Hormuz when we have not shown any goodwill to actually relinquish the Strait of Hormuz to them? And at any moment, any given morning, if people wake up and realize that Trump's tone is all wrong and Iran is not willing to play ball, and if the Houthis are being a little bit more tight on the Bab el-Mandeb, which is the primary relief valve for the East-West pipelines, it's we could just wake up and people could be get me into oil, on a 90-degree angle, and I need to have inventories under 100 a barrel. And
that's the one thing that doesn't make sense to me, is why there seems to be a concerted effort to drain inventories at any price.
Well, yeah, I mean,
why weren't you refilling, considering the potential outcomes? Why weren't you refilling at $70?
Well, we're not at demand destruction approach in pricing, and refilling is like kind of a heavy lift. Like you need to first go to Congress and get them to set
Yeah, but I'm not talking about the U.S. I understand why the U.S. is not doing it because it's the U.S. war. But why isn't South Korea, Japan, China,
Trust me,
Europe?
they were buying up every single barrel that was globally available. We have been short barrels, like a substantial number of barrels.
But there's you can destroy demand between 70 and 80. They should have bought everything between 70 and 80.
No, you can't. You can't destroy demand between. These are market forces. Like unless they're going to literally like China basically can do that, which they did. They were like, yeah, like we're not importing above a certain price. But every other country in the world has like capital markets and stuff that they can't really like unless they're going to outlaw like refining, which is basically apparently like China to at least like a certain extent like basically banned like they might have curtailed a substantial amount of refining, which is why like their imports dropped like 40% immediately. But look, I mean, besides what countries are going to do or what they've done, which like I can't speak as expertly on, what I will say is that as an equity markets investor, this is a really great, okay, so this is a big like put smash day, big squeeze day. We got a big drop in like AI names that like, now can recover a little bit. There's probably some degenning going on in Korea. There's probably a guy that was like on life support and like was about to like write his suicide note who like now is like, he's being made whole, and that's great. But what I am starting to become concerned about is a scenario where oil has very substantial upside. We actually have the episode in oil that many thought was going to come by July, but was delayed by the MOU, because I don't see the path to another MOU from Iran's standpoint. They just saw that an MOU is not in their like that approach is not in their interest. Can
I throw a counterpoint at you?
Yeah.
What if China and Iran are big braining this and they realize that there's no demand destruction at $70. They want to keep oil low so that we do deplete inventories and keep on burning so that the runway is actually shorter.
No, totally, but we're there. Like that's my point is that they've been doing that. They were doing that. And I think that was a big part of the strategy for Iran in terms of not speaking as hawkishly and pushing back on the Trump administration's claims that we were going to, all through April, every time we would come out and say, oh, we're close to a deal, everybody would be like, okay, it doesn't seem like we're close to a deal. Why isn't Iran, why isn't Iran denying this? Because isn't it in their interest to keep oil prices high? And it's like, exactly to your point, they actually were fine with the U.S. walking down oil prices because it stimulated greater demand for oil and led to a faster draw of inventories. My point is that we're actually already there, where when you model it out and you model out even with the delay, you take the Brookings Institute's piece where they said, okay, before the MOU, they said we get to, the cushions are all gone by early July, and then you have a 7 million barrel per day gap that needs demand destruction pricing, which to them they said was over 120 and closer to 150. That was pushed back a few weeks by the MOU. The adjustment for that now is kind of first or second week of August. So it's like we're kind of there. Like they don't need to like draw down. Our STR is at its lowest level, absolute level in terms of quantity, since April of 1983. Like we've run it all out. So it's just now a question of, you know, you can wake up, and that's what makes these markets hard. They're very opaque. They're very difficult to model, even for the experts. I mean, much less the tourists like us. But it's, I guess the point is just to say,
How many barrels do you think we're short? 7?
I mean, it depends with the Babel Mandeb. Like, if the Babel Mandeb is like truly going to be restricted, or you know, because the Houthis said that there's like a Saudi maritime ban now. Not easy for them to enforce, but like honestly, like what do you need to do to enforce it? Like you throw some like fucking paper airplanes with bombs strapped to them. It's closer to 10 if the Babel Mandeb is like partially shut. It's 7 with the Babel Mandeb open. A million per day. So yeah, what I'm saying for equity markets is this: is like that scenario to me is obviously extraordinarily economically destructive if it is allowed to last. It has no bearing on the fundamentals of maybe AI or anything like that, but it does have bearing on the fundamentals of the wealth of the people that own AI stocks. And for everything else that's like super economically sensitive, obviously, it's just like really bad. And so it feels like a really good reason to like not be like super wrong.
You know, so I just asked Bede, and 5 million demand destruction would take 150 barrels per oil. 7 million, 187, 10 million, 232.
Yeah, it's all about elasticity. Like,
oh, that's conservative. Okay, let's do base 135, 152, 183.
Okay, yeah, I think 150 is like kind of like an okay bogey. Yeah, so like the whole point is just to say that like this could be like I swear to God, it could be like a 5-day correction. It could be a 3-day correction, but it could be theoretically S&P 500 down 10, NASDAQ down 15 in 3 days until Trump like basically like comes out and is like he just has to concede the whole Strait of Hormuz to Iran. Like, I don't know why we went back to contesting it. I don't understand. I know why we say we did for freedom of navigation, all this shit, but it's like sometimes you just get owned. Like, you need to just be cool with getting owned.
Yeah, so you're saying you like Fang.
I'm saying I don't want to trade this. I'm saying
You just want to sit on the sidelines.
I'm sitting on the sidelines because I swear to God, if I short stocks and I buy oil, Trump will.
Yeah, I tweeted that everyone's scared to long oil. Granted, it is up.
Yeah, but it's way below where it could be. But it's like I honestly don't want to trade this again because Trump could do literally anything. But if it goes the negative scenario, literally it could just delever everybody. Everybody could get nuked. It could be like Liberation Day 2.0. And then it could set up some really awesome opportunities because it's like, all right, this guy's gonna like fold his cards basically immediately if the market doesn't. That's Iran's entire advantage. I was just talking to my dad about this. Like, Iran's entire advantage in all of this is like it's just rate of change of like state of life. Like, they've gotten bombed, their leaders have gotten killed, they're eating sand. They've been doing that for a long time. Like, they've been on sanctions for a long time. And it's like, for us, like, they don't have to, Iran does not have to answer to a stock market. It doesn't have to answer to a bond market. The Iranian currency is like fucking worthless. It hit a new low today against the dollar. They don't care. Like, sand costs the same. It tastes just as good on a sandwich. Like, but if the stock market goes down like 10% in like 3 days or something, we're literally going to be like, okay, fine, like you can have the waterway. And so that's because like you go from like, it's like if the air conditioning shut off everywhere in the country all at once, like there would probably be a civil war in 10 days because nobody would know what to do with themselves. Like, we are too comfortable. So Yeah, that's a separate point, but it's just to say that like it is a market point too, because if we do get a sharp enough correction, it's like you have to bet on Trump just like eventually being like, damn it, like fine, like I need to make the stock market go back up, or like I'm gonna get impeached before November.
I'm looking at some cool thing. I'll call you from the car. I got a long drive.
All good, brother. I'll talk to you later.
Okay, talk soon.
My life.
Okay, so this is cool. I've seen this before, but what the fuck is this? That don't look right. That don't look right. Somebody should buy at the money. Like, what is that? What is that little ring call? What do we think, guys? What do we think? What do we think? Is there opportunity down there? Sell, buy. What do you think? Spreads? Who's got some diagonal ideas based off of this? Okay, but going back, I do want to say we're dead if that's reality. Also, go back to Groupon. Uh, I like these. I like the 35s. I like just earnings, and the reason why I like earnings is because of this. And you guys might have seen it while Liam was talking. Okay, price targets, wide range. None of them really excite you. What is that based on? Shit. Where I got so many. I need new screens. I need new screens. Okay, I'm just pulling this over. Oh yeah, it was literally right there. Okay. EPS, nope. EBITDA, quarter, give me quarter. How do we get quarter? Q2. Okay. So this is based off of $14.6 million of EBITDA. I think it's going to be 17 or 18. So if we're going back here, all price targets have to go up. That's our whole new trajectory. Look at that chart. It just goes down. If it beats by that much, I think we're like it's a totally new trajectory. Best leading indicator. I don't know what that is. Yearly. It's a totally new trajectory. Okay. That's where we start looking at 85, $90 million of EBITDA. So anyway, it's hot. I have to go. I have to roll. Anyway, overall, good day, Chamath. Thank you for pooping on Groupon for all of us. Really nice. Appreciate you. Hello, Oklahoma. And yeah, windinchlibrary.com. If you guys have not seen that yet, share this. Maybe it's not for you, but it's for somebody. Made this for free. You just got to know how to spell Windinch. That's the cost of entry. Library.com. And it's pretty sweet. There's 4 tracks. This is basically everything anyone will ever tell you to read. Got some quant stuff. I got help with portfolio construction, economics. You will be pretty interested of this. Paul Tudor Jones, and it's got a summary for you. It's kind of like a Wikipedia. Um, it's like a Wikipedia start, and once you do that, you can read summary of Livermore. If you find something that interests you, you could buy the book. A lot of these are out of, like you can get Reminiscences of a Stock Operator. It's out of copyright. I don't even know if it was ever in copyright. But you can decide to read it in its entirety. But it's a really good overview of what to study, and some intelligence has gone into it. So anyway, it's going to be the last live of the week, but hope you guys enjoy the rest of the week. I'll be in Discord and Substack. I just won't be able to go live because I'll be